What if the biggest opportunities in precious metals emerge not from hype, but from the quiet rotations happening beneath the surface of today's turbulent markets? Good day, everyone, and welcome to this special market update on the world of gold and silver. I'm your host, bringing you clear, professional insights into these timeless assets that continue to play a vital role in global finance. Today, we dive deep into recent developments from short-term price movements to broader investment principles that shape long-term success in commodities and equities. Let's explore how current conditions might unfold for precious metals investors worldwide. Markets have shown notable volatility lately. Gold prices experienced a modest decline, while oil surged amid geopolitical developments involving Iran. At the same time, expectations around potential Federal Reserve actions have shifted, with many participants anticipating adjustments in monetary policy. These shifts prompt important questions for anyone involved in resource sectors. Do sudden moves alter established strategies, or do they present opportunities for those focused on enduring value? A seasoned value investor, speaking from a conference in Florida, emphasized a disciplined approach. Rather than chasing daily fluctuations or attempting precise forecasts, the focus remains on assessing risk versus potential reward from current levels. This perspective stands in contrast to reliance on technical indicators or short-term predictions. Instead, it highlights evaluating opportunities based on fundamentals, regardless of immediate headlines. This principle applies particularly well to the precious metals space. Gold's appeal has long stemmed from its monetary characteristics, especially amid concerns over fiscal policies and currency stability across major economies. Recent quarters brought a correction in prices, yet the underlying drivers appear resilient. Governments worldwide continue to navigate significant budget challenges, with limited signs of improved fiscal discipline in places like the United States, Germany, or Britain. Such conditions support the case for gold as a store of value even through periods of adjustment. Corrections are a natural part of market cycles. History offers perspective, including a notable 45% drop in gold prices during 1975, accompanied by even steeper declines in related equities. Similar mid-cycle pullbacks occurred in the mid-2000s. The latest adjustment followed unexpected geopolitical tensions that boosted oil, but such events rarely alter the bigger picture for monetary metals. Patience and a long-term viewpoint help investors navigate these phases effectively. Meanwhile, broader equity markets have witnessed intriguing shifts. The technology sector, particularly concentrated in artificial intelligence-related names, has shown signs of fatigue. Major companies have seen substantial market value adjustments since earlier peaks, while certain international indices entered correction territory. Capital appears to be rotating toward other regions, with notable gains in Chinese equities like Alibaba. For global value investors, this raises compelling questions about where fresh opportunities may lie. Those heavily positioned in the most crowded trades may not always align with traditional value disciplines. However, foreign markets outside the United States have lagged for over a decade, a remarkable stretch of dominance by American large-cap technology. international investors seeking exposure to innovation previously funneled capital toward U.S. hyperscalers. As that dynamic evolves, with several major names declining sharply while broader indices held relatively steady, rotations are underway. Recent performance illustrates the point. Over short periods, select technology giants dropped significantly more than the wider S&P 500. This movement favors both value-oriented and smaller capitalization stocks. Year-to-date comparisons show value strategies outperforming growth by notable margins, while small-cap indices have posted impressive relative gains. Foreign markets as a whole also delivered stronger returns last year and continue to show resilience. Such rotations often benefit overlooked sectors. Commodities and resource equities, including those tied to gold, stand as potential beneficiaries when capital seeks diversification. Generalist investors and institutions not currently active in precious metals could gradually increase exposure once broader equity momentum moderates. When monthly statements reflect plateauing or declining performance in core holdings, relocations become more appealing. Gold mining shares, despite strong fundamentals in many cases, remain under-owned by the wider investment community, creating conditions for potential catch-up participation. Passive investing has profoundly influenced these dynamics. Retirement accounts, particularly in the United States, channel substantial flows into broad indices through automated contributions and employer matches. This creates persistent demand for large U.S. equities, reinforcing trends until sentiment or performance shifts prompt reevaluation. Limited options for commodities or emerging markets within many plans further concentrate capital. Understanding these structural elements helps explain why rotations, when they occur, can accelerate. In the precious metals arena, sentiment indicators reveal extremes. Gold mining equities currently register among the lowest bullish readings in decades, far below typical balanced levels. Such conditions often precede improved participation as awareness grows. While technology capital rotates, portions could find their way into resources, especially if fiscal and monetary outlooks remain supportive for hard assets. Stepping back, today's environment underscores timeless investment truths. Success rarely comes from predicting exact price targets or following crowd momentum. It arises from disciplined evaluation of asymmetric opportunities where potential rewards outweigh identifiable risks. For gold and silver, this means recognizing their role beyond industrial or decorative uses as hedges against policy uncertainty and currency debasement. Silver, often moving alongside gold, but with unique industrial characteristics in electronics, solar, and medical applications, benefits from similar monetary tailwinds while offering additional leverage through supply constraints and growing demand. Market participants monitoring both metals can appreciate their complementary positions in diversified portfolios. Looking ahead, several factors warrant attention. Geopolitical developments influence energy prices, which in turn affect inflation expectations and central bank decisions. If policy responses reinforce concerns over long-term debt sustainability, precious metals retain structural advantages. Investors focused on value continue scanning for companies with strong balance sheets, attractive valuations, and capable management. qualities that endure across cycles. The current correction in gold, while noticeable, fits within historical patterns rather than signaling fundamental weakness. Mid-cycle pauses allow markets to consolidate gains and attract new capital at more reasonable entry points. Those maintaining long-term horizons often view such periods as constructive rather than concerning. Global capital flows add another layer. As performance gaps between U.S. mega-cap technology and international markets narrow or reverse, opportunities broaden. Emerging markets, including those in Asia, present selective value for investors comfortable with regional dynamics. China, for instance, has shown responsiveness in certain technology and consumer names, illustrating how capital seeks efficiency. Value investing principles emphasize margin of safety. Rather than extrapolating recent trends indefinitely, practitioners analyze current pricing against underlying assets, earnings potential, and replacement costs. In resources, this includes evaluating reserves, production costs, and geopolitical risks alongside macroeconomic backdrops. For viewers interested in precious metals, maintaining perspective proves essential. Daily price action matters less than the accumulation of evidence regarding fiscal trajectories, real interest rates, and currency confidence. When multiple major economies face similar challenges, the appeal of scarce tangible assets tends to persist. As rotations unfold, gold and silver equities could capture increasing attention. Mining companies with disciplined operations and exploration potential often reward patient shareholders. Silver producers benefiting from byproduct credits and primary mines add diversity within the sector. Education remains key in navigating these markets. Newer participants benefit from understanding not just price charts, but also the supply chains, central bank behaviors, and investment demand drivers that shape longer-term trajectories. Professional analysis focuses on facts, avoiding sensationalism while highlighting genuine opportunities and risks. In summary of today's discussion points, the interplay between monetary policy expectations, sector rotations, and historical precedents offers a rich framework for precious metals analysis. Value-oriented approaches that prioritize risk-reward assessment over predictions provide a steady compass. While short-term volatility continues, the foundational case for gold and silver endures amid ongoing global fiscal realities. This environment invites thoughtful allocation. Whether through physical metals, exchange-traded products, or quality equities, diversification across jurisdictions and company types can enhance resilience. As always, individuals should consider their unique circumstances, time horizons, and risk tolerances when engaging with any market. Looking forward, continued monitoring of capital flows, sentiment shifts, and policy developments will prove informative. The precious metals sector, with its deep history and contemporary relevance, stands ready for those prepared to approach it with discipline and perspective. Expanding on these themes further, let's consider how such market phases have played out previously. During past cycles, periods of technology concentration eventually gave way to broader participation across asset classes. Commodities often entered favor as inflation hedges or growth plays in different economic regimes. Gold, in particular, has demonstrated its ability to perform during times of uncertainty. while silver's dual role amplifies movements when industrial demand aligns with investment interest. Current low sentiment in gold equities creates a contrarian backdrop. When participation is minimal, incremental inflows can have outsized effects. Retail and institutional investors alike may rediscover the sector as portfolio rebalancing occurs. This process unfolds gradually, rewarding those positioned ahead of the curve rather than chasing momentum. Fiscal developments worldwide merit close attention. Persistent deficits and rising debt levels across developed nations support the monetary thesis for precious metals. Without meaningful reforms, these pressures are likely to persist, bolstering demand for assets outside traditional paper systems. Central banks themselves have increased gold reserves in recent years, signaling institutional recognition of these dynamics. On the supply side, mining challenges including regulatory hurdles, labor issues, and declining ore grades in certain regions constrain new production. This structural tightness can amplify price responses to demand shifts. For silver, industrial growth areas such as renewable energy technologies add another supportive layer, potentially leading to tighter market balances over time. Investment strategies in this space benefit from thorough due diligence. Analyzing individual companies involves reviewing reserve quality, all-in sustaining costs, balance sheet strength, and management track records. Diversification across producers, developers, and royalty companies can balance risk profiles. Geographic spread helps mitigate jurisdiction-specific challenges. Market psychology plays a significant role. Extreme sentiment readings, whether overly optimistic or pessimistic, frequently mark turning points. The current subdued enthusiasm for gold miners contrasts with broader market participation in other sectors, setting up potential for mean reversion as conditions evolve. Technological advancements also intersect with precious metals. While artificial intelligence drives demand for certain materials, gold and silver maintain roles in electronics and specialized applications. Long-term innovation trends do not necessarily diminish their monetary status. Instead, they coexist within evolving economies. As we navigate these complex intersections, maintaining a clear framework grounded in value principles serves investors well. Assessing opportunities from current valuations rather than extrapolating trends encourages rational decision-making amid noise. Further reflections on passive flows highlight structural shifts in capital allocation. Automatic mechanisms channel trillions into broad indices, creating inertia until performance disappointments prompt changes. When that occurs, the scale of potential reallocation can be substantial, impacting sectors that have lagged. For the gold and silver community, this represents an ongoing opportunity to articulate the case for inclusion in diversified portfolios. Educational efforts, transparent reporting, and professional stewardship all contribute to greater market maturity. In closing this extended analysis, the path ahead for precious metals involves both challenges and prospects. Geopolitical events, monetary policy decisions, and capital rotations will continue influencing near-term movements. Yet the longer-term drivers, rooted in economic fundamentals and asset characteristics, provide a foundation for resilience. Viewers are encouraged to stay informed, conduct their own research, and approach markets with patience and discipline. The world of gold and silver offers depth for those willing to engage thoughtfully. This comprehensive overview draws together recent observations, historical context, and forward-looking considerations to equip you with a balanced perspective. Thank you for joining, and may your investment journey be guided by insight and prudence. We look forward to updating you on future developments in these vital markets.